Welcome to the latest Motley Fool Scoreboard. I'm Anand Chokkavelu, and we've got longtime fools Jason Hall and Tyler Crowe giving a 1 to 10 rating to a Moneyball company I found a lot more interesting after listening to Tom Gardner and Andy Cross interview the CEO a few months ago. It's Sterling Infrastructure, ticker symbol STRL. First, we'll rate the strength of Sterling's business, including factors like industry and competition. A 10 is invincible, a 1 is hopeless. Both of you are at 7s, Tyler.
Yeah, I said 7, and I say this a lot. We need to grade on a curve here because it's more industry that I'm talking the number down a little bit. Sterling it's construction, and specifically it's a subcontractor that does site and slab work, which means like preparing the ground and pouring foundations for buildings. As is with many construction businesses, the good times are awesome. Margins expand, looks awesome, and lean times can feel pretty awful. Site work and slab work in particular is a little tough because simple slab pours for like single family homes and distribution warehouses aren't exactly like rocket science. It's an incredibly intensely competitive industry with, multinational builders all the way down to some dude with an excavator and a dream trying to make it work. So, Sterling has an intriguing position in this particular market right now, but it's an inherently tough position to defend in this industry.
Yeah, I think 7 is right here. If I were to sum it up in just a few words, cyclical pressures and capital intensivity, it's not a great combination. Sterling's a leader for a few reasons. They've been very savvy operators. They've navigated the cycles really well over the past, let's call it, decade and a half.
Speaking of those operators, let's talk about management. A 10 is Warren Buffett. A 1 is Homer Simpson. Both of you agree once again, but this time a little higher. 8's Tyler.
Yep. Credit where credit is due. This was a stuck business that was in trouble in the early 2010s. It really focused on heavy site and civil work. So doing like roads, bridges, things like that. And management went into adjacent site and slab work for building residential homes and became one of the go-to subcontractors for the big home builders. Then it got into this, what they call it, infrastructure, which is, I would say, like a nice rebranding for doing site and slab work for data centers and e-commerce warehouses. These are two segments that have higher margins because, heavy civil works like bridges, like they're way more cost sensitive to site work because it's a bulk of the spending versus, home builders and site and slab where the other work is a bigger component. So it just happens that infrastructure is also having a moment with the boom in AI spending. I would say my one gripe on management is that the board seems to be setting some pretty low hurdles for management, and they seem to get very generous paychecks. Like if I could hit 200% of my target bonuses every year since 2017, I feel like I'm getting some good participation trophies.
Yeah, exactly. Participation trophies and not stretch bonuses. I think that's a key there. But let's, like you said, give them credit. 8 may be the floor here. If you think about what they've done in refocusing the business where there's margin opportunity and salvaging a company that was in a little bit of trouble. But I think we also should just consider that, the past 15 years has generally been a pretty good economic tailwind environment, and lower interest rates have also helped them, but management sees that opportunity.
For financials, a 10 is a fortress, a 1 is yikes. Jason's at a 7, Tyler, you're at an 8.
Yeah, actually overall good. And the net cash position is looking really nice. It has strong cash generation right now, but we can't go a full 7-minute video without me airing some grievances about a company because that's what I do. Remember, this is construction. It has thin margins. It's cyclical. Site and slab work has more fixed and equipment costs than other contractor types. So when the market turns, it has to hand out more cash to keep the lights on. I think that cash burning that is generated right now is burning a hole in management's pocket because they've ramped up its acquisitions pace and is buying back stock at more than 8 times book value. I would rather they sit on the cash like they're guarding the treasure of Erebor and just kind of wait for the construction market to hit the skids, because eventually it will, and that cash will be very valuable.
Yeah, I don't want to ignore the cyclicality. There's other companies that have overlap in these kind of opportunities like MCorp. It's a very variable expense. They don't have a lot of equipment and capital costs for a company like that. They have people, and how much they're working is going to depend on how much they make. When you're buying excavators and dump trucks and those sorts of high capital cost things, they're going to be on your books no matter how much the opportunity has gotten weaker. So continuing to navigate that is important, but I think you have to back down the score a little bit because that is part of the reality with their financial profile.
Jason, let's talk valuation. How well will Sterling Infrastructure's stock do over the next 5 years? How safe is it? Keeping in mind a 10's a sure thing, 1's a lottery ticket.
This is the land grab phase of the build out for accelerated computing. And we're starting to see companies monetize, which means that more investment's going to continue to flow into it. So I think that tailwind is good. And over the next 5 years, the return profile could look somewhere between 10 to 15%. Also, there's not a zero probability of losing money. The safety score is a 5. This is a premium valuation. And 5 years from now, if we're at a weak spot in the cycle, the stock price could be below where it is now. We've seen that happen with this company multiple times in history. So it all depends on how the e-infrastructure demand cycle plays out and persists. So that's the risk here.
Yeah, I said 10 to 15% returns with a safety score even lower at 4. I think Sterling Infrastructure is kind of like a Rorschach inkblot test for like how optimistic you are about AI capital spending over the next 5 years. This particular part of the business is the highest margin, fastest growing. So if you think that AI CapEx spend will stay this high and keep growing over 5 years, then more than 15% is entirely possible. I'm pretty comfortable with that thought for like 2 to 3 years, but I'm wondering if there isn't some like investor crisis of confidence in those out years and we see a pullback in spending. So, I can see high returns, but I don't feel great about it over that long period of time.
Time for everyone's favorite topic. Jason, is there a company in Sterling space you like better?
Yes, I'm going to squint a little bit here because it gives me an opportunity to talk about a Brookfield business here. I prefer to look beyond the picks and shovels, the companies that are making the things in infrastructure, because all of those cyclical risks. Brookfield Infrastructure gives me an opportunity to win across the cycles by actually owning and monetizing that infrastructure, not dealing with the build out cycles.
So I did it on a recent scorecard that we did. I said Quanta Services, also a subcontractor, specifically in electricity and doing a lot of like grid work. So it has that upside from AI build out and that sort of thing. But there is the long tailed component of grid resiliency that will really put like a floor on that business, much more so than I think a lot of AI construction related companies.
Thanks to Jason Hall and to Tyler Crowe. They've given Sterling Infrastructure an all right overall score of 6.9 out of 10, failing a bit on safety. Look out for a new scoreboard every market day at 7 p.m. Eastern. Next up is EOG Resources. Till then, Fool on.
I swear, that was like apples to apples of the dumbest sentence I just made.